A very good morning, friends. So I hope you're all doing well. And most importantly, I hope you made your revisions in terms of at least the last session where we started a block number 2 with reference to the consolidation procedure. As I promised on the new year that I am going to make a little mind map before we go forward, I introduce you to the 7-step model, how the consolidation process is going to take place. We discussed a couple of adjustments as well. We discussed a total of 6 adjustments with you. And I am now going to first of all make a summary chart, or I would say a mind map, considering all the 7 steps and the 6 adjustments, what are going to be the focus points under each and every step. So that, once we attack a particular question, your weapons, the knowledge is a weapon, your knowledge is very clear in terms of what kind of thought process is to be applied under each step. Because when we did the adjustments, of course, I gave you that in each of the adjustments, which step is going to get impacted. But I think now I'm going to do a consolidation of all the adjustments with all the individual steps with you. And trust me, if you made a revision, this is going to be something really enjoyable and something really interesting to you. So let's begin the journey. I'm going to first of all start with a little mind map before we come to the larger practical questions with you. Now, the very first focus when you start a question on a consolidated balance sheet is you need to first of all identify if there are any omissions. Don't go to the step number 1. I'm being very clear on my thoughts. I'll do question also on that particular area today. So the first thing what you're going to do is I'm going to put this as a note. The very first thing you need to do is see if there are any omissions. So the very first thing you're going to do is see if there are any omissions. So when you read the question, try to locate if there are any kind of omissions, and generally, I'm saying generally, you will see the omissions would be pertaining to the concept of a purchase consideration. But let me also tell you that these omissions may be by the parent or these omissions may be by the subsidiary. You must take care of them. So when I say that if there are any omissions, that omissions could be from anybody's point of view. So these omissions could be either by parent company, I'll put it as holding company, or it could be by the subsidiary company. That doesn't make a difference. So when you see that there are any kind of omissions, you need to make an extract balance sheet. Look at the entries and prepare an extract balance sheet before you proceed with the consolidation process. So when you see any kind of omissions, it's time to prepare an extract balance sheet. It's time that we prepare an extract balance sheet. So this should be the very first focus point. Even before you start the 7-step model, this is going to be your very first focus point. See if there are any omissions. And generally, when you see omissions, you will see omissions by the parent company. And you will see the omissions generally relating to purchase consideration. So generally, you will see that there are omissions relating to purchase considerations. It could be a deferred consideration or it could be a contingent consideration, which of course is paid in the shareholder's capacity. Now, when you see that there is a deferred consideration omission, you just need to remember that you will capture the DC. You will capture the DC and you will also consider the unwinding of discount. That should immediately come to your mind. Unwinding from the date of acquisition till the date of consolidated balance sheet. So this unwinding is going to be, you can say, from the date of acquisition till the date of consolidated balance sheet. So this is what should immediately shoot to your mind. And when it is a case of a contingent consideration in the shareholder's capacity, you will capture this as well. And along with this, you will see any fair value changes if it is a financial liability. So this is what should come to your thoughts immediately when you look at omissions. So first take care of any omissions, make the extract balance sheet before you proceed to the 7-step model. Next, with this inputs, then we come on to the 7-step model. Now let's make a run through in terms of each and every step, that what kind of complications could arise under each of these 7 steps. We're going to make a comprehensive view in terms of looking at all the kind of adjustments which can confront in a given step. Now, as far as the step number 1 is concerned, there is nothing technical which you will confront. Step number 1 is simply getting the acquisition date and getting the percentage. So this is not going to be a big deal. So when you go to get the date of acquisition and the percentage, I don't see that there will be any complications which would arise in this particular case. Okay, then comes the step number 2. Now, when you go to the next step, that is step number 2, immediately as you go to the step number 2, at the back of your mind, you don't need to tell this to the examiner, but this is for your own reference, that you're going to see what is the type of question. So we're going to filter all the questions on balance sheet into 2 buckets. Either it is a consolidation on acquisition date or it is a consolidation later. So we're going to put them in 2 different buckets. NCI or no NCI would not make any difference. So in this particular case, when you see the type of questions, either it is a consolidated balance sheet on date of acquisition itself, or it is supposed to be a consolidated balance sheet at a later date. Now, one thing which you need to remember very clearly, that if it is a consolidation on the date of acquisition itself, then we are just working step number 2. But if it is supposed to be a consolidation at a later date, then we are working in terms of step number 2A as well as in terms of step number 2B. So there will be 2 steps which will get confronted. So this is what you need to decide on your own. There is no need of telling the examiner that you filtered the question in terms of 2 broad categories. 99% the chances are that you're going to get a question which is at a later date. So invariably, you get a question more on this area, because if it is a consolidation on acquisition date, there is hardly any complications to be handled in that case. But still, so in this particular case, the step number 2, in this case, you will take the list of all the assets minus the list of all the liabilities, and we need at fair value on the date of acquisition. Now, let me also remind you that in this particular case, when you're getting the list of net assets, trust me, you need to apply all the inputs what you have done in business combination standard. So you mean to say all those concepts which we did in terms of recognition, measurement, exceptions, intangible assets, etc.? Yes. So when you're looking at the net assets calculation, remember, you need to consider all the inputs covered in 103, all the inputs which are covered by Index 103. So I think in this case, when we did the step number 3, if you remember, that was the step number 3 in this acquisition accounting, where I give you the complications in terms of step number 3A and B, deferred tax as well as the list. So all those considerations should be inputs covered by that. I'm just making a reference. That is step number 3A and the step number 3B. So all that inputs is going to be applied here as well. I mean, I'm just thinking enlarged, that all those inputs which were there will be equally applicable here as well. Now, coming back out here, if the consolidated balance sheet is at a later date, in terms of step number 2A, we need to consider the analysis of other equity. So we need to do the analysis of other equity. And if you recall, I did not document this, but I definitely made a mention that there will be a total of 3 focus points at the back of your mind. When you're doing the analysis of other equity, you've got a total of 3 focus points. So let's see what are the 3 focus points which we need to consider in this particular case. Now, the first one is that when you look at the analysis of equity, you are going to pick up the other equity of the subsidiary. The analysis is of the other equity of the subsidiary. So first of all, you're going to pick up the other equity of subsidiary company. The second focus point in analysis is go in the additional information, see if there is any stock reserve which is upstream in nature. The third is go to the additional information and see if there are any fair value adjustments. So we're going to see the additional information for any fair value adjustments. We'll see any stock reserve which is upstream in nature. So all this information is going to be available in the additional information. So these 3 focus points need to be very clear. When you do the analysis, be careful that we need to consider analysis of the subsidiary, other equity. Then we need to consider the stock reserve, which is upstream, not downstream. And we need to consider the fair value adjustments. Now, what is done in a fair value adjustments? You know that. What is done in a stock reserve upstream? You know that. So I'm not documenting that part. That we've already covered in detail. The other thing is you need to take care of the dividends, but I'm not putting it out here. These are the 3 focus points. Next, when you go to the step number 2B, in this particular case, you need to get the net assets at date of acquisition. And as we decided earlier, that when you're going to consider the net assets on the date of acquisition, you are not going to consider assets minus liability, but equity share capital plus pre-acquisition other equity. So in this case, the net assets will be equity share capital plus the other equity, which is pre-acquisition in nature. Now, what is the focus points at this stage? When you do the step number 2B, you've got 1 focus point. If there is a dividend in the question, you need to organize 2 net assets. One is a net assets before dividend and one is a net assets after dividend. And you know why we're organizing that. One is for the goodwill and one is for the NCI purpose. So when you go to the net assets on the date of acquisition, there is 1 focus point. There is 1 focus point if dividend is paid. So if you find that if dividend is paid, we will organize net assets before and after dividend. So we will organize the net assets before as well as after dividends in this case. So your mind needs to be very clear, that, okay, when I'm doing this step, this is the focus point which should come at the back of the mind. So in terms of the net assets, your immediately thought should be, okay, am I given a dividend is paid by the subsidiary? Yes. Then let's organize the 2 net assets. One is before the payment of dividend and one is after the payment of dividend. Okay, this is step number 2. Then we go on to the step number 3. And in terms of the step number 3, we just need to organize the purchase consideration. Now, when you organize the purchase consideration, here again, the caution is, there is an important caution which we have not discussed so far. So in this particular case, it is important that you pick up the investment in holding company's balance sheet, and you should bifurcate this. You should bifurcate this because there might be some outside investments. So I would say when you pick up the investment in the balance sheet, bifurcate this in terms of investment in subsidiary company. And if there are any other investments. When I say other investments, we are focusing in terms of the outside investments. So in this particular case, we'll focus in terms of what are the outside investments, because in the consolidated balance sheet, if we identify whether this will appear or not, this doesn't appear, but this will definitely appear. So when you go to the step number 3, just see if there are any other outside investments, because all the investments in the balance sheet of the parent may not be simply investment in the subsidiary. He might have made any other outside investment as well. So identifying those outside investment is going to be a very important task. And another important focus point is when you consider the purchase consideration, just see that there is a need to look at the extract balance sheet. Because if there has been any kind of omissions, then your extract balance sheet would be the right place to pick it up. So you should pick this information, you should pick up this information from the extract balance sheet. I think that's it. But let me also tell you one more thing at this stage. Are all the inputs relating to purchase consideration, which we covered in Index 103, is it equally applicable out here? 100% yes. So which means that to put it in a very comprehensive manner, I would say all inputs covered in Index 103 would apply. So that means all the concept of calculating a PC as per Index 103 is going to be equally applicable in this particular case as well. I'm giving you a broader thought process in terms of how you're going to think. Next, we come to the step number 4. Now, in terms of the step number 4, we are calculating the NCI. Now, as far as the NCI is concerned, you will take the NCI on the date of acquisition. That is one. Now, when you consider the NCI on the date of acquisition, this is as per Index 103. It is going to be as per Index 103. That means either at a fair value or at PUSNA. So all the figures will be taken accordingly. So completely as per 103. Now, the important input. I'll give you the focus points. So let me just add now the focus points in this case. So I'm adding the focus points in terms of NCI. So I would say there are a total of 3 focus points again. I think that makes life simple. Step number 2A, 3 focus points. Then step number 4 also 3 focus points. In terms of NCI, the 3 focus points are: number 1, when you consider the NCI at PUSNA, in this particular case, we'll take the net assets after dividend. We will consider the net assets after dividend. So this is one focus point, that you need to consider the net assets, which is after the payment of dividend, because we need the NCI for the consolidated balance sheet. The next focus point is that when you take the NCI, we need to add the share in post-acquisition profits. We need to add the share in the post-acquisition profits. And then there is another third very important focus point. If your NCI is at a fair value, then the goodwill impairment is to be reduced at this stage. So when you consider the NCI calculations, the third focus point is less goodwill impairment share, if NCI is at fair value. So these are the 3 most important input focus points in terms of NCI. I am consolidating each and every step in a very comprehensive manner. as we're going to do questions now, I'm going to put questions back to you in terms of the focus points to be seen. So get this very clear. If the NCI is at PASNA, we need the net assets after dividends. The post-acquisition share is to be added, and there will be a goodwill impairment share provided the NCI is at a fair value. So that is on the step number 4. Next, come to the step number 5. Now, in terms of the step number 5, that is the calculation of goodwill, or you can say capital reserve, call it as a bargain purchase gain. BPG, that's called a bargain purchase gain, or call it as a capital reserve. Well, the calculations are pretty simple, but I would say in this case, there is only one focus point. Rather, let's take it 2 focus points. So let's consider 2 focus points. You consider the PC and you add the NCI, and you also need to reduce the net assets. So I think to make it absolutely crystal clear, let's, I think, consider 3 focus points itself. Not that I'm, converting them on a very, stringent basis, zabardasti into a 3-step, but yes, it is going to be a 3 focus points again. Let's see. So I would say here also, when you calculate the goodwill, there is going to be 3 focus points, and that will keep the thoughts very clear. Now, the focus point number 1 is, when you take this NCI, do not take it from the previous step. Do not take it from step number 4. So do not take this from step number 4. So if the NCI is at PASNA, I give you a mention as well, do not take it from step number 4, because in terms of step number 4, this is based on net assets after dividend, and we need it on net assets before dividend. So in this particular case, we will not take this from step 4, but we will take NCI based on net assets before dividend. So in this particular case, your focus points need to be very clear that when you go to take the NCI, you go to take the net assets, which is without reducing dividend, and then take the NCI. Now, the second focus point is, when you take the net assets out here, we need to take net assets before dividend. We need to take the net assets before the payments of dividend in this case. And then there is a third focus point as well. And the third focus point is the goodwill impairment, irrespective NCI is at a fair value or it is at PASNA. So we need to reduce goodwill impairment. We need to reduce the goodwill impairment in this case. And let's put it out here, irrespective NCI is at fair value or it is at PASNA, that would not make a difference. Because when we reduce the goodwill impairment out here, we reduce the entire impairment figure. So we reduce the entire impairment amount in this case, not the share. Great. So 3 focus points in terms of the goodwill calculations. I hope you're going to keep all this in mind as we proceed with the question. Okay, so this is step number 5. Let's go next. That is step number 6. So in terms of the step number 6 as well, when you do the consolidated balance sheet, that is other equity. Now, guess what? Here also, I'm going to get 3 focus points again. My God. Step number 2A, 3 focus points. Step number NCI, 3 focus points. Goodwills, 3 focus point. Other equity, 3 focus points. You cannot afford to, not remember all this, because I think if you know the common figure is the three focus points in these steps like jingalala. So in this particular case, we take holding companies own other equity as a base. And remember, when you take this as a base, there might be a need to pick this from the extract balance sheet as well. So when you go to pick this figure is also going to be picked up from the extract balance sheet, because if you made an extract balance sheet, pick it from there. Now, as I said, there is going to be another three focus points here as well. So let's see what are the three focus points in this case. So let's see the three focus points in terms of other equity. The focus point number one, you need to consider the share in post-acquisition profits. You need to consider the share in post-acquisition profits, which you're going to pick up from step number 2A. So we'll take the share in the post-acquisition profits picked up from step number 2A. Next, we need to consider number one, the stock reserve, which is downstream in nature. Number three, we need to consider the goodwill impairment, share of the parent company of the goodwill impairment. And there is a fourth adjustment also, which is pertaining to dividends, which I'll put it out here. So in this particular case, the next one is reduce the stock reserve, which is downstream in nature. Reduce the stock reserve, which is downstream in nature, and then reduce the goodwill impairment. Reduce the goodwill impairment, and if it is supposed to be full goodwill, then I'll reduce the share of parent. Then I'll reduce the share of the holding company. And if it is supposed to be partial goodwill, I'll reduce the entire impairment loss in that case. And I think just to add on the next point, though I've kept it as three focus points, we can say there's another fourth point also, which is reduce the dividend received by holding company from subsidiary company, because this does not represent, you can say, an income from the consolidation point of view. It's not a group income. So if there is any dividend which was credited by the parent company, that also needs a reduction. So if you want, instead of three focus points, you can make it as a four focus points as well. Either ways, but this is something which you'll remember otherwise. So to make the consistency, three focus points. Okay, so this is as far as the step number 6 is concerned, and then comes the step number 7. Now, as far as step number 7 is concerned, nothing too complicated indeed. So when you see that you're going to make a consolidated balance sheet, I think few things which I need to take care is I'm just putting those basic thoughts. So you need to remember that you will aggregate the assets and liabilities 100%. That is one big focus point. You need to remember to show the NCI as a part of equity section in the balance sheet. So we need to show this as a part of the equity section in the consolidated balance sheet, because invariably this is something, which we might forget. Then we also need to consider that we add the fair value changes to assets and liabilities. We also need to consider to eliminate intercompany owings. We also need to consider the elimination of intercompany owings. And we also need to consider that we need to reduce the stock reserve, whether it is upstream or it is downstream from stock. It is to be reduced from the stock. So that is something more which we need to take care. So I think these are the major inputs, what you need to keep in mind. I would say more or less 5 focus points. So I would say these are the basic 5 focus points which you need to consider in terms of preparing a consolidated balance sheet as well. Wow. I guess that's done. And I think just let me add on out here, and we also need to reduce the additional depreciations as well. So this takes care of all my focus points in terms of all the 7-step model. I think, friends, if you made revisions, this would have been an icing on the cake, giving you all the key focus points. So remember, in step number 2, that is step number 2A, 3 focus points. In terms of step number 2B, 1 focus point. In terms of step number 4, 3 focus points. In terms of step number 5, 3 focus points. In terms of step number 6, 3 focus points. And in terms of the step number 7, 5 focus points. If you're able to keep a track of all these focus points, you can never ever go wrong. Right? I think I've spent a good time on that, but I think that was the need of the hour. I hope this mind map helps you to crack now the question on a consolidated balance sheet. Comfortable? So are we ready to go to a little comprehensive question now further, applying all these insights, the learnings in a question? That's wonderful indeed. So I think let's take the journey forward now. I didn't get many yes on that, just a single yes anyway. I think my constructive obligations to give all these things. Okay, I got a yes now. So I think last time I did a question with you from the study material where there was no NCI. I think now I want to do a similar kind of question before we go to a little complicated one. And this is a question number 5 in the test your knowledge. This is question number 5 in the test your knowledge question. I am just going to crop this to show it. So let me just zoom this across. Let me know, friends, if this is visible to you. Right. I hope that's visible, right? It's a question which is in the study material. Great. Now let's, I think, read. It is quite similar to the one which we did, except that there is an NCI. We will do a little more complicated question, which is a recent examination question also, which contains some better adjustments. It says Ram acquired 60% ordinary shares. It says Ram acquired 60% ordinary shares of Krishnan on 1st October X1 and the balance sheet is given on March X2. I think the immediate thoughts which should come to the mind is that this is a balance sheet at a later date. So we need to consider step number 2A and step number 2B in this case. The retained earnings of Krishnan showed a credit balance of 60 on April X1, out of which a dividend of 10% is paid. Ram has credited the dividend to retained earnings. The fair value of the machinery on 1st October is given. The depreciation rate is given, and following are the increases in comparison to the fair value as per Ind AS with the book value on 1st October, which are to be considered while consolidating the balance sheet. So these are all fair value adjustments. It may be assumed that the inventory is unsold on the balance sheet date and the trades payable are not yet settled. The other reserves on the balance sheet date is same as on 1st April X1. Absolutely similar, except that there is a 60% stake. Rest everything is exactly similar. Okay, so I think let's begin the inputs. Let's, I think, solve this out. So we're looking at test your knowledge. That is question number 5. Now, in this particular case, I am now going to work out, first of all the thought processes which I've given you. Let me put the first question. Is there a need for an extract balance sheet? Do you see any omissions which are given in the question? I think no. There are no omissions given in the question, so there is no extract balance sheet required in this case. Great. So we start our journey in terms of step number 1. So in terms of step number 1, we will identify the date of acquisition, and we will identify the percentage. So I think the date of acquisition is very clearly given to me. I'm keeping the question in front of me, and you can also open this question in front of you. So the date of acquisition is 1st October X1, and the percentage is very clearly given. It is 60%. That's right. Then we go on to the step number 2, and we've already identified in the background of our mind that this is a case. This is a case where the consolidation is done later. So you need to work out a step number 2A as well as a step number 2B. Now I think I have a little lesser space at this end. So what I'm going to do, I will technically work out my step 2B in this case. I'll get my net assets at date of acquisition. Let me just take different space for the step number 2A. So let's organize the step number 2A. So in terms of step number 2A, we are looking at analysis of other equity. So let's define this categorically in a chart. We'll take a column for pre and post acquisition. Just getting the formats very clear so that there is no challenge. So in the analysis of other equity, we consider pre-acquisition. This is going to be pre-1st October, and this is post-acquisition. Anything from 1st October till 31st March, that is going to be post-acquisition. So this is continued pre-acquisition and post-acquisition. Now tell me, how many focus points are there when you're doing this analysis of other equity? Give me the number. So how many focus points do we have in this particular case when you're doing the analysis of other equity? Great, 3. So we're going to see the other equity in the balance sheet of the subsidiary. We're going to see the fair value adjustments in the additional information, and we're going to consider the stock reserve, which is upstream. There is no stock reserve given, but yes, we've got fair value adjustments. So let's first begin with the balance sheet of the subsidiary. Now, if you look at the balance sheet of the subsidiary, we can clearly see that this is the reserves as well as the retained earning. Now, as far as the reserves are concerned, it was very clearly given in the additional information. The balance on March and 1st April is exactly same. So let's take the reserve, that is 2 lakh. So when I consider my reserves, I will consider a timeline as I've already done earlier. So we know this is the balance on 1st April and this is the balance on 31st March. The balance of reserve was 2 lakhs at the beginning and it was 2 lakhs at the end. So I think you can easily define me that what is pre and what is post. My date of acquisition is in the middle of the year, but 2 lakhs is the balance at the beginning of the year. So can I say the entire 2 lakh becomes pre-acquisition in nature? There is no post-acquisition increase, so that is 0. Similarly, we look at the retained earnings. Again, we make a timeline. So in this case, the balance on 1st April and the balance on 31st March. Let's get back to the balance sheet. So as far as the retained earnings are concerned, it is appearing at 164 in the balance sheet. And it says retained earnings showed a credit balance of 60,000 on 1st April X1, out of which a dividend is paid. So dividend is paid on the share capital of 4 lakh rupees, that is 10%. So the balance at the beginning is 60. The balance at the beginning is 60 and the balance at the end is 164. So out of the 60,000, is that 60 still available? The answer is no. We paid a 10% dividend. And somebody asked me last time as well, and I made it very clear that in terms of the step number 2A, I will definitely reduce the dividend. I will get the amount which is post the dividend. So we paid a dividend on the share capital of 4 lakh 10%. So this works out at 20,000. The rate of acquisition is in the middle of the year. So would you like to tell me how much is pre and post? So 20, of course, is pre, and then there is an increase of 144 during the year. So can I say this 20,000 undoubtedly is pre, and what about the increase? Is it post? Or is it going to be divided in the time ratio?
Half, 72-72.
Wonderful. So since it is in the middle of the year, so 72 pre and 72 will be post, and that's what takes care of the balance sheet. Focus 1 is done. The other equity in the balance sheet of the subsidiary is taken care. Focus number 2. Now we need to consider the fair value adjustments given in the additional information. See, if you start thinking on a chronological order, that these are the focus points and you pick them one by one, you cannot go wrong. Let's go back to the balance sheet to see the fair value adjustments. The fair value of the plant and machinery on 1st October is 4 lakh rupee and the depreciation rate is 10%. Now, the plant and machinery is standing in the books of accounts at the end of the year at 2 lakh 70. So let me do some workings. So we come to the plant and machinery at the end of the year 31st March, it is appearing at 2 lakh 70. If the depreciation rate is 10%, can you tell me what will be the book value at the beginning of the year? Gross it up. I guess it comes to 3 lakhs, right? So 270 represents 90%. So gross it up, we get the value at the beginning of the year, there is 3 lakh. Now, since the revaluation is done in the middle of the year, we need a book value in the middle of the year. So let's see what is the value on 1st October. So we reduce a depreciation 15,000. And I think this works out at 285. And this is revalued at 4 lakh rupees. So we will be able to get a revaluation gain. And I think that's 1 lakh 15. It's pre-acquisition. Anything else related to plant and machinery? Is there anything else to be taken care in terms of plant and machinery?
Depreciation.
Absolutely correct. So we need to consider the additional depreciation. I want you to calculate what is the additional depreciation. Are you going to consider on 1 lakh 15,000 10% 6 months? Yes or no?
Yes.
No. We did that last time. I said, don't take this on 1 lakh 15 at 10%. You need to work out what was taken and what should have been taken so carefully.
Correct.
Yes. So can I say we should have taken a depreciation on 4 lakhs, but we took a depreciation on 3 lakh. So we need to take a 10% depreciation 6 months on this figure. Because we should have taken a depreciation on 4 lakh for the next 6 months, but we took it on 3 lakh. So on 1 lakh, 10%, 6 months. I think that comes to 5,000, right? Okay, so plant and machinery revaluation is done. Let's pick up the other revaluations as well. So then it says the following increases as compared to the book value is given. So land and building is 2 lakhs, inventory is 30. So land and building increase is 2 lakh, no depreciation rate given. Inventories increased by 30,000. And trades payable increases by 20, that's a loss. Right, I think that's it. So anything else in the analysis or we are sorted? I think we are sorted, right? We've taken the other equity in the balance sheet. We've taken the fair value adjustments. No stock reserve upstream is given in the question. So I think we can comfortably get the pre and the post acquisition profits. So this is 2 lakh plus 20 plus 72, 1 lakh 15. Is this coming to 6 lakh 17, I guess? And this is, I think, 67,000. Right, just see if the calculations are correct, I guess. Right, step number 2A is done. Now let's go to the next step. That is step number 2B. So we come to the next step. That is step number 2B. And what is the focus point in terms of step number 2B? So when you're going to take the net assets on date of acquisition, what is the focus point? So what are you going to do when you calculate the step number 2B? And so what's going to be the focus points? Two net assets calculations to be done before and after dividends, right? So we need the net assets before dividend and we need the net assets after dividend. That's what I gave you. The dividend is the key agenda. So we need to organize two net assets for this purpose. Now, let's first take the net assets from the calculation of the analysis. 6 lakh 17. So let's take the sum total of equity share capital and other equity. This is, I guess, 4 lakh and this is 6 lakh 17. So this comes to 10 lakh 17,000. And if I take it before dividend, can you tell me what will be the other equity before the dividends? I guess we add 40,000 back, correct? So in this case, the dividend is paid 40,000 rupee. Just add back the dividend. That comes to 657. So this is to the extent of 1057. So the moment you calculate the step number 2B, your mind needs to be very clear that yes, I need two net assets calculation. One is before dividends and one is after the dividends. Wow. Okay, now let's come to the step number 3. So in terms of step number 3, what is the focus point in terms of purchase consideration? The basic focus point in terms of step 3, there is no exact balance sheet, etc. But one of the crucial inputs in terms of step 3 will be what? Locating the outside investments, right? Okay, so let's go back to the balance sheet, see what is the status of the investments. I guess the investment in Krishan is given 8 lakhs, so there is no outside investments. So this remains at 8 lakh rupees itself. Okay, so I think this is taken care. Then we go to the step number 4. And step number 4 is the calculation of NCI. Now tell me, friends, what is the focus points in terms of NCI? How many focus points? Wonderful. There are 3 focus points now in this particular case. So one is that we need the NCI. So we need to consider the net assets after dividends. And then we need to consider the post-acquisition share. And if there is any goodwill impairment, there is no goodwill impairment which is given. So in this particular case, let's consider the NCI on date of acquisition. We are taking Pasna itself. So let's take the figures after dividend. So 10 lakh 17,000 and 60% belongs to the parent. So 40% belongs to the NCI. That's 406,800. To this, we add the share in post-acquisition profits. To this, we add the share in the post-acquisition profits. And the post-acquisition profit is 67,000. And 40% of this belongs to the NCI. That's 26,800. There is no goodwill impairment. Otherwise, we would have seen whether it is full or is it partial goodwill in this case. So this works out at 433,600. That is the NCI. Great. So step number 4 is done. Now let's come to the step number 5. Step number 5 is in terms of calculating the goodwill or the bargain purchase gain. How many focus points in terms of goodwill now? So number of focus points in terms of goodwill?
3.
That's right. So one is that we need to consider the NCI not from the previous step, but we're going to consider net NCI based on before dividends. We'll take the net assets before dividend, and if there is any goodwill impairment, which is not in this case. So we take the purchase consideration, that is 8 lakh. And we add the NCI on date of acquisition. But just to remember, don't take it from the step number 4. So we take the net assets without dividends. The net assets without dividend is 1057. So this is going to be 1057 into 40%. That is the NCI on acquisition date. That's 422,800. And this is to be compared with the net assets on date of acquisition. That's 1057, again, without reducing dividends. So we will get the goodwill or the capital reserve as the case may be. So 165,800 is the amount of goodwill in this case. Great. Okay, so step number 5 is done. Now we go to the step number 6. Then we go to the step number 6, which is getting the other equity in the consolidated balance sheet. Now tell me how many focus points to be taken care in terms of step number 6.
4.
And that's right, 4 focus points. So one is the post-acquisition share, one is the dividend, which is to be eliminated, one is the stock reserve, which is downstream, and one is the goodwill. So there is no stock reserve, there is no goodwill, we just need dividends and post-acquisition. So we'll take first of all, holding company's own other equity. And I think for this purpose, we'll have to segregate 2 columns. Because there is other reserves and there is retained earnings. So we'll make 2 separate columns for this. Let's go back to the balance sheet. So if you look at the parent company's balance sheet, other reserves is appearing at 6 lakh and RE is 1,14,400. So other reserves is 6 lakh and RE is 1,14,400. To this, we add the share in post-acquisition profits. The share in post-acquisition profits. And this is, I guess, was 67,000 into 60%. 67,000 into 60%. That works out at 40,200. And then we need to consider stock reserve is not there. We just need the dividend elimination. So dividend which they received. So dividend was paid, I guess, 40,000. 60% belongs to the parent company. That's 24,000. It's not an income from the group point of view. And I think that's it. So this takes care of the other equity as well. So this remains at 6 lakhs itself. 1,14,400 plus 40,200 minus 24. This is 130,600. And this will appear as a total 730,600. Well, so step number 6 is also done. Now we are ready to go to the step number 7, preparing a consolidated balance sheet. So by the way, after getting all the focus points, how do you find the question is easy or tough? Or is it moderate? There's a reason of asking that.
Very easy.
Wonderful indeed. So I'm inclined to know that I want to do a little comprehensive question if the time permits, which is going to be a wonderful question, which includes the impact of deferred tax, everything and all. Not now, later. So let's go to the step number 7. And step number 7 is making a consolidated balance sheet. And for this, I've already given you a complete formatting. We're going to consider one column for the holding, one column for the subsidiary, one column for the adjustments, and then get the sum total. So this is the holding company, subsidiary company, adjustments, if any, and get the total, which is the consolidated balance sheet. So let's begin with the assets side of the balance sheet. So first of all, on the non-current assets, we're given the property, plant, equipment comprising of 2 items. One is land and building, and one is plant and machinery. So land and building is appearing at 3 lakhs, and this is 3 lakhs 60. And I think there was a fair value adjustments in terms of land, I guess. That was, I believe, 2 lakhs. No additional depreciation. So this comes to 9 lakhs 60. This is land and building. The plant and machinery is 4 lakh 80. And for the subsidiary, it is 2 lakh 70. And what was the fair value adjustments for the plant? It was 1 lakh 15, I guess. Yes, 1 lakh 15, and additional depreciation was to the extent of 5,000. So this will be 4 lakh 80 plus 270 plus 1 lakh 15 minus 5. This comes to 8 lakh 60. Right, so this is done. And then let's go further. Okay, I think this is 860, I guess, calculation error. Okay, so this is the non-current assets. Investments will not appear. And then we've got the goodwill, least we forget. I guess the goodwill which we calculated was 165,800. Then there are current assets in the balance sheet. Current assets, we are given trade receivables and cash. Trade receivables is 1 lakh 19. Sorry, I forgot the inventory first. Let me just take the inventory to begin with. So there is inventory. So inventory is 2 lakh 40. And it is 72,800. And there is a fair value adjustments that is 30, no stock reserve. So 240 plus 72,800 plus 30, that makes it 342,800. Then next we are given trade receivables, and then there is cash and cash equivalents. The trade receivable is 1,19,600. And it is 80,000. And there is no fair value adjustments or there is no intercompany owings. That makes it 199,600. Then there is a cash balance which is 29 and 16. No adjustments again. That makes it 45,000. I think that's it on the asset side of the balance sheet. So let's see the sum total of the balance sheet now. 24,73,200. 24,73,200 is the total of the balance sheet. Right. So the asset side of the balance sheet is done. Now let's, I think, go to the liability side of the balance sheet. Same formatting continues. So one column for the parent, subsidiary, adjustments, and the total. Holding, subsidiary, adjustments, and the total. So on the liability side, we've got equity and liabilities. So let's consider the equity. Equity share capital, other equity, and NCI, least we forget. Share capital only for the subsidiary parent company, that's 10 lakh. Other equity you can take from step number 6. That is 730,600. That is 730,600. NCI we can take from our calculations. That is 433,600. That is from the step calculations. I think equity is done. Then there is no non-current liability, just the current liability is given. There is a bank OD and there is a trades payable. The bank OD is 1,60,000 for the parent, nothing for the subsidiary. So that goes in the total. And trades payable is 94,200. And this is 34,800. And there is a fair value change of trades payable increase by 20. And I think that's it. So 94,200, 34,800 plus 20, that's 149. So now we can take the sum total of the balance sheet. That comes to 24,73,200 is the total of the balance sheet. Wow. So this is done. The balance sheet is agreed. And I think this is pretty simple indeed. Is this the kind of questions you can get in the exams? Of course, yes, with a little more adjustments. But to me, if you ask me, this is damn simple indeed, not at all complicated. I think we can definitely increase the level now. Let's do an examination question with you, which has got some more interesting issues in this case. So should we prepare the consolidated balance sheet similarly in 5 columns in the exams? I would say yes. That's an easy task because you will be able to avoid making working notes as well. So I think it's a good idea to do that. If you're a little apprehensive, then what you can do, you can merge these columns and make a single column as well. And then in that case, you can show holding plus subsidy minus adjustments, make it as a working note in between, and then make the balance sheet. Otherwise, you'll have to technically, make all this as a part of the working note. I did it like this because that's how we practically do it as well, because it's done on an Excel sheet and then all those things are taken care. So this is practically, embedded kind of solution, I would say. Okay, so let's now go further. I'm now carrying a question with me, which is an examination question. Let's, I think, do that question with you. Okay, let's have a look at this particular question. This is an examination question. Let me just slightly crop this up. It's January 21 examination question. Came for 15 marks in the exam. Got some new points, so I thought it's a good idea to do this question with you. Let's read the question number 10 on the screen. It's a January 21 examination question. It says on 1st April 17, A acquired 80% share capital of S. On the acquisition date, the share capital and the reserves are given 5 lakh rupees and 125 respectively. Wow. If you notice, he's telling you that what is the share capital and reserve on the date of acquisition. This is going to give me the net assets on acquisition date. So does this mean that I can avoid doing an analysis of other equity? Of course not. Because analysis of other equity is not just considering the split of the balance sheet equity. There are fair value adjustments also to be taken. So even if he gives you the share capital and reserve on the date of acquisition, don't get carried away with the fact that the analysis of equity is not required. We'll still do that. Then he says A paid an initial cash consideration. Additionally, A issued 2 lakh equity shares with a nominal value 1 at a current value of 1.8. So PC is paid in the form of cash as well as in the form of shares. It was also agreed that A will pay a further sum of 5 lakh after 3 years. Now, if this is paid after 3 years, that means this is supposed to be a deferred consideration. And the cost of capital is given 10% and the discounting factor at the end of each year is given. It says the shares and the deferred considerations have not yet been recorded by A. So what is coming at the back of your mind when you read that it says the shares and the deferred consideration not yet recorded? What comes to the mind is omissions. And when it comes omissions, what is the focus point in your mind?
Extract balance sheet.
Wonderful indeed. So what we're going to do, we are going to make an extract balance sheet in this case. Before we proceed with the 7-step model, we're going to make an extract balance sheet. Look at the entries for the issue of shares. Look at the entry for the DC along with the unwinding. And then I am given the balance sheet on March 19, which is 2 years later. That's the balance sheet. Let's see further. Then it says in the additional information on the date of acquisition, the fair value of the plant exceeded the book value. That's a fair value adjustments. And the remaining life of this plant is supposed to be 5 years on that date. The consolidated goodwill is impaired. And then it says the A Limited values the NCI using a fair value, which means the goodwill is supposed to be full. And if the goodwill is supposed to be full, the impairment is borne by the parent and the NCI all. At the date of acquisition, the fair value of 20% NCI is already given. You are required to make a consolidated balance sheet on March 19. Notes to accounts is not required. So I think my format of doing that consolidation in a columnar wise will be a good deal. So I think I can see the only focus point is just around 2-3 things. There has been omissions which will take care in the extract balance sheet. There is a fair value adjustments to be taken care in step number 2A as well as step 7. And there is a goodwill impairment in terms of step number 4, 5, 6 because it is full goodwill. Let me ask you in advance before we solve this question. Do you think that this question seems to be very complicated? Considering now that you know that what is to be done for each adjustments, doesn't it sound easy? Say yes. Sounds
Yes.
easy. Great. And trust me, this is one of the toughest questions I've seen in the exams. So the questions can get more interesting on a consolidation, and trust me, if you blend an element of deferred tax implications as well. We'll see later. So let me solve this question number 10. First, we're going to work upon the extract balance sheet. So the answer to the question, that is answer to the question number 10. Let's first work upon the extract balance sheet. So we'll first put the journal entries and then make an extract balance sheet before we proceed with the 7-step model. Now, there are two omissions which are clearly stated in the question. One is the issuance of shares and one is the DC. So let's do one thing. Let's put the journal entry. So I'm looking at the omission as far as shares issued are concerned. And I'm looking at the deferred consideration. Now let's go date by date. It is on 1st April 17 that the company acquired the shares in S Limited, and it says that we issued 2 lakh shares with a market value 1.8. So can I say on 1st April 17, I would have done the entry investment debit, equity share capital gets a credit, and the share premium gets a credit. Because if I would have done this entry on the date of acquisition, the entry would have been investment at a fair value, share capital with a face value, and the excess as a premium. So can I say investment will be 2 lakhs into 1.8, share capital will be with the face value 1, and the rest 0.8 becomes the premium. Okay. Because of this omission of this entry, will there be any consequential changes in the next 2 years, or that's it? Even if I would have done this entry, will it lead to any consequential impact over the next 2 years?
No change.
That's right. So can I say no further entries? Because this entry would have been done, then no further entries would have been done. Now let's come to the next one, that is on 1st April 17. Had I taken the deferred consideration, the entry would have been investment debit and the deferred consideration would have got a credit. Let's go back on the DC. So I'm given that it was agreed that we'll pay 5 lakhs after 3 years and the third year factor is 0.75. So in this particular case, we would have paid 5 lakhs after 3 years. Let's take a present value at the factor 0.75. This would have been 3,75,000. So this entry would have been done on 1st April 17, that is on the date of acquisition. Any consequential impacts of this entry over the next 2 years?
Yes.
That's right. On March 18, unwinding, and on March 19, also unwinding. So the entry would have been finance charge gets a debit and DC gets a credit. And even in the next year, finance charge gets a debit and DC gets a credit. Though technically this finance charge will be debited to the retained earnings because we have already closed the balance sheet. So unwinding will be at 10%. So can I say this will be 37,500? And what will be the interest for the year ended 19? Is it going to be on 375 or plus 37,500? So it'll be on the cumulative amount 41,250. Okay, so this would have been the status of the entries had we recorded the deferred consideration. Now with this entries, we are in a comfortable position to draft the extract balance sheet of the parent indicating the changes in the balance sheet. So let's make the extract balance sheet now. So we are going to make the extract balance sheet of A Limited on 31st March 19, indicating the changes. So because of this balance sheet, investments will undergo a change on the asset side, liability side, equity share capital, and then you can say other equity and DC. So let's first look at the asset side, non-current assets, investment. Let's go back to the balance sheet. So investment is appearing in terms of thousands at 1,000. So investment is appearing at 1,000. Let me just add the omissions. So investment gets recorded at 360 and 375. So please remember to take the figures in thousands. So 2 lakhs into 1.8 is 3 lakhs 60. We're adding the figures in 1,000 and we're adding this 375. So this is the new value of the investment. That is 1735. I'm just putting a tick on the entries just to keep a track of the change. Then we go to the equity section of the balance sheet. So we need to change the equity share capital. The equity share capital is appearing at 2,000. So to this 2,000, we add this 2 lakh rupees, that is the face value, that's 200. So that works out at 2,200. Then next, I think in the other equity, we need to change the figure of RE. There is share premium and there is going to be retained earning and premium. That's it. So let's get back to the balance sheet. So in the existing balance sheet, I think there is no premium, just retained earnings 1,400. So retained earning is 1,400, and to this we reduce the interest, that is finance charge, in terms of thousands, 37.5 as well as 41.25. So 1,400 minus 37.5 minus 41.25, that's I think 1,321.25. And the share premium appears at 160. Let's see, everything is done. This investment share capital premium done. I think the only thing left over is DC. So DC will also appear in the balance sheet. And is it going to appear at current liability or non-current liability, by the way?
Current liability.
That's right, because now it's payable 1 year later. So 375 plus 37,500 and 41,250. I think it comes to 453.75. So this is going to appear in the current liability because now this is payable 1 year later. Wow. So I think my extract balance sheet is done. Now I'm in a position to start my 7-step model in this case. Okay, so now let's begin with these 7 steps. The entries are done. Now let's go to the 7 steps. So we go with the step number 1. Date of acquisition and the percentage. As far as date of acquisition is concerned, I think it is 1st April 17. And as far as the percentage is concerned, I guess we acquired 80% shares. So this works out at 80%. And then we know at the background that this is a question of the category, which is acquisition. The consolidation is at a later date. So which means there are 2 steps, step number 2A as well as step number 2B. So let's do the step number 2A, analysis of other equity. So we'll first make a chart. So 1 column for the particulars, then pre and post. So this is pre-acquisition and this is post-acquisition. This is pre-1st April 17 and anything from 1st April 17 till March 19, that is the post-acquisition period. So in this case, you can see the post-acquisition is comprising of 2 years now. Now we know that when we do the analysis of equity, again, there are a total of 3 focus points. So first we're going to pick up the other equity of the subsidiary. Then I think there is no stock reserve which is given, and there is fair value adjustments. I think only one fair value adjustment is given. So let's go back to the balance sheet of the subsidiary. So in the balance sheet of the subsidiary, the retained earnings is appearing at 300. And I think if you go to the first para, it says the reserves at the acquisition date was 125. So let's make a timeline. So we're looking at the retained earnings. Let's consider a timeline. So retained earnings on 1st April 17 is 125, and the retained earnings on March 19 is 300. So would you like to define what is pre and what is post acquisition in nature? I think the balance on acquisition date is undoubtedly pre. And can I say the balancing figure 175 becomes post acquisition? Great. So I think this is done. Then we need to consider the fair value adjustments in this case. Let's go back to the additional information. I guess in point number 1, we are given the fair value adjustments. The fair value of the plant exceeded the book value at 2 lakh rupees, and the remaining life is 5 years. So the fair value change is already given. So plant and machinery, the fair value increase is 200. We also need to consider the additional depreciation in this case. Now, the remaining life of the asset is supposed to be 5 years. So can I say this 200 will be spread over the remaining life? And how many years depreciation do we need to consider?
2 years.
That's right. So divided by 5 into 2, I think the additional depreciation is 80. I think that's it. Nothing else is given on the analysis. So I think we can comfortably take the sum total of this pre and post. So this is 325. And I think this is 95. Right. So I think my step number 2A is done. Now we can organize step number 2B. So in terms of step number 2B, the best part is there is no dividends. If there is no dividends, I think the focus in terms of step number 2B is not required. So we just need the net assets on date of acquisition, sum total of the equity share capital, as well as other equity, which is pre-acquisition in nature. So let's go back to the balance sheet to see the equity share capital of the subsidiary. Equity share capital of the subsidiary is 500. And the pre-acquisition equity is 325. So I think that works out at 825. Wow. So I think my step number 2A and step number 2B is done. Now we can go to the step number 3. So where do I look at the step number 3 for the calculation of the purchase consideration? What should be the focus point to see the investment balance sheet or extract balance sheet? So we're going to look at the extract balance sheet to get the figure. So we'll see the information on the extract balance sheet 1735, because once you've made the extract balance sheet, pick the figure from that particular information. That's right. And then we come to the step number 4. Step number 4 is the calculation of the NCI. Now, since there is no dividends which are given in the question, I think the 2 focus points are gone. I don't need to consider the net assets, after dividend. We just need to consider the post-acquisition shares, and we need to consider the goodwill impairment focus. So NCI, I think, is at a fair value in the question, right? So let's get back to the additional information. It says in point number 3 that value of the NCI using fair value and on the acquisition date is 3,80,000. So NCI on date of acquisition is 380. And to this we add share in post-acquisition profits. We add the share in the post-acquisition profits, and the post-acquisition profit is 95. So we take care of 95 into 20%. That's 19. And since the NCI is at a fair value, we also need to pass on the goodwill impairment share to the NCI as well, because NCI is at a fair value. So let's get back to the additional information. So goodwill stands impaired by 258. So goodwill is impaired by 258. So into 20% belongs to the NCI. So 258 into 20%, that's 51.6. And this is going to give us the NCI. 380 plus 19 minus 347.4. Right, step number 4 is done. Then we come to the step number 5. Step number 5, that is on the goodwill or the bargain purchase gain. So here again, we've got focus points in terms of considering the net assets before dividends, but dividends are not there. So I think that is not to be taken care. The only thing is the goodwill impairment. So we take the purchase consideration, add the NCI. Right now, can I pick this NCI from the previous step? Yes or no?
Yes.
Correct. So purchase consideration is 1735, NCI is 380, and then we compare this with the net assets, and net assets is 825. So we're going to get the goodwill 1735 plus 380 minus 825, that's 1290. And how much is the amount of impairment we will reduce? Full amount or 80%?
Full.
That's right. So we'll reduce the full amount of impairment, that is 258. Because this is calculating the revised value of goodwill, so we'll take care of the full value. That's 1032 is the amount of goodwill. Step number 5 is done. Now the focus is on step number 6. So we go to the step number 6, which is consolidated balance sheet, other equity. And in this case, again, let's make a columnar information. There is retained earnings and share premium. So let's take the share premium and the retained earnings. So we're going to first pick the holding company's own other equity. So where are you going to pick this information now? Carefully. Which place are you going to pick this information?
Extract balance.
Wonderful indeed. So this is going to be taken from the extract balance sheet. Because we've already made the changes, let's get this from the extract balance sheet. So this is appearing at 1321.25. This is 1321.25 and this is 160. Now, there are 4 focus points in terms of other equity, but I think there is no dividend, so that is gone. There is no stock reserve, so that is gone. Goodwill impairment and post-acquisition, these are the only 2 inputs. So we consider the share in post-acquisition profits. And let's go to the analysis. So the post-acquisition profit was 95. So we take 80% of this, 95 into 80%. That is 76. And we reduce the goodwill impairment 100% or 80%?
80% of 258.
That's right, because here we need to reduce the parent share. That's 206.4. So this will give us the other equity for consolidated balance sheet. This is 160. This is 1190.85. Let's add this up for the balance sheet. 1350.85. That is the other equity in the consolidated balance sheet. In a way, if you notice, step number 6 is nothing, but you can say this is more like, making a SOKI, because this is a column information which is making a statement of changes in equity technically. Okay, so this is done. Now, finally, we go to the step number 7. And step number 7 would be making a consolidated balance sheet. Since no notes to accounts are required, I think columnar calculations would be great. Holding, subsidiary, adjustments, and total. So holding company, subsidiary company, we get the adjustments and the consolidation, that is total. Okay, so I think let's start with the assets side of the balance sheet. I think I now need the informations. So starting with the asset side, we have got PPE, non-current assets PPE. The parent company is 5,500. Subsidiary is 1,500. And I think there was a fair value adjustments, I think 200, right? And additional depreciation was, I think,
5
80, right? So 5,500 plus 1,500 plus 200 minus 80, that's 7,120. Investments will, of course, not appear in the balance sheet. Then we have got goodwill. And goodwill was how much?
1032.
1032. And then we take care of the current assets. So inventory, receivables, and cash. Inventory, receivables, as well as cash. So inventory is 550 and 100. There was no fair value adjustments, and I think there is no stock reserve, nothing. It comes to 650. Then receivables is 400 and 200. I think there are no intercompany owings, nothing. Then cash is 250. I guess there are no adjustments again. So that's it on the asset side of the balance sheet, I guess.
9652.
9652. Okay, so now we can make the liability side of the balance sheet. The asset side is done. Same lines. Columnar information. So holding, subsidiary, adjustments, and total. So holding company, subsidiary company, adjustments, and the total. So let's consider the equity and the liability section. So first we start with the equity section. We've got equity share capital, then there is other equity, and there is NCI, least we forget. Equity share capital will be just the parent. That's, I think, 2,000.
No, sir, 2200.
Yes, extract balance sheet. You're right. So this is from the extract balance sheet. Then other equity in step number 6, 1350.85. And NCI can be taken from the step of NCI.
347.
347.
Yes.
I think it was slightly different. 347.4.
4.
Yeah. 347.4. So that's on the equity section. Then there is non-current liabilities. So non-current liabilities, and that's to the extent of 3,400. But I think there is no adjustments. That works out at 3,400. And then there is current liabilities in which we need to take care of DC. So current liability is 1,250, 650, and then there was a DC in the extract balance sheet.
454, I think. 454.
Not rounded off.
453.75.
453.75. So 453.75, that's the deferred consideration. So this is going to be 1,250, 650, 2,353.75. I think that's it. This should close the balance sheet, I guess. $9,552. Difference of 100. Did we leave something 100? This is 2,200, 1,350.85, 347.4. Yeah, it's tallied. I think additional error. This is 9,652 only. So this is 9,652. The balance sheet is tallied. Wow. So this is, I would say, one of the most comprehensive questions, which is there in the exam, but I don't see that this is too complicated indeed. I think the only good point was on the extract balance sheet. Goodwill impairment is normal. Fair value adjustments is also pretty much normal indeed. Okay. Right. So I think this takes care of questions which are without any chain. Now my focus is to do a question with you, which is on a chain holding. But I think before that, we'll give you a break. So we're going to now do a question which is on a chain holding. There has been, I think, questions on the chain holding 2 times at least in the exams. So it's not very different from the way we consolidate a question without a chain holding, but there are some crucial points which we need to consider when there is a chain holding. So we'll take care of that inputs after the break with you. So that will be the focus chain holding. So once that is done, consolidated balance sheet issue is taken care. Then the focus will be in terms of consolidated income statement thereafter. Any questions so far on your mind? Otherwise, I think time to give you a break and then we start the journey back.
Sir, are there other adjustments also which we have to take care of, something like bonus or something?
Yes, there has been a recent question which came, but trust me, as far as the bonus issue is concerned, you can practically ignore that adjustment for all effective reasons. Because if a bonus issue is made, the bonus is already a part of the balance sheet. There was a recent question in the exam, and I think if the time permits, I might do that question also. It's, I think, came just around a year and a half back in the exams. So, but in any way, I think that is adjustment which can be practically ignored and the questions can be done. So we'll maybe take care of that. But yes.
And preference share capital adjustments, sir.
Yes, I think because that is another good question which has come in the exam. So I think after
at
chain
least
holding, the
yes,
time may not get permitted today, but maybe in the next session, I would definitely try to, do that question with you.
Or take one extra class for this, sir. On
Let's see, because I'm already running short of time.
right. Thank you. Thank you.
There's so much to do in consolidation, that we still live with 111, we still live with 28 and a bit of 27 as well. So I just, every time I start counting, in terms of, what are we within the time frame or not. So I just try to, be on the time frame. So I think well taken. I guess I'll try to incorporate that in the next session, maybe. Not promising that, but I think I'll definitely try to incorporate that past examination question in the class.
Thank you.
Thank you. Right, friends. So we'll take a 10-12 minutes break and I'll start back. Please enjoy your break. We'll start back. Thank you. Hope you had a relaxation of mind. So now, as we said, we've done questions without a chain. Now we're going to see a question which is with a chain holding. Everything remains exactly the same. The same seven-step model would apply with a few little changes here and there, which we need to consider. But the overall approach in terms of the seven-step model would equally be applicable as well. So let me, I think, first take you to a question on a chain holding. So this is a question which came in the exams in November 2018. I'll just zoom this across to you. It came for 16 marks in the exam. I hope it is clearly visible, I guess. Right, that's great. So let me first read the inputs in this particular question. It says we're required to make a consolidated balance sheet on March 18 for a group of companies comprising Usha, Nisha, and Sandhya. And the summarized balance sheet is given, nothing major to be seen in the balance sheet so far. Though I think it was a very old question. So I think if you look at the balance sheet, it's not exactly in the division 2 format, but that's perfectly okay. Then it says the following additional information is given. Usha has got 80% shares in Nisha, and Nisha has got 75% shares in Sandhya. So we can see a chain. And all the shareholdings are acquired on 30th September 17. And then it says the business activities of all the companies are not seasonal in nature, and you can assume that profits are earned evenly throughout the year. I think this assumption goes even if the question is silent. We'll always safely assume that if the question is silent, the profits are always earned uniformly over the period. On 1st April 17, at beginning of the year, the balances in the books of Nisha and Sandhya is given. So the position of reserves and RE is defined. 5 lakh is included in the inventory of Nisha. Nisha is supposed to be the middle company and which is purchased from Sandhya. So is it upstream or downstream? Sandhya is the bottommost company and Sandhya made a sale to Nisha. So that means it's up, or is it downstream in nature? That's right. It is upstream. Correct. So we'll take care of this in the analysis. The parent company has adopted an accounting policy to measure the NCI at a fair value. Applying Ind AS 103, assume market prices of Nisha and Sandhya are equal to the face value. So fair value and the face value is considered equal. Then I think the point number 6 can be ignored. So you need not go through that. It's more to do with, a language of AS21. So let's ignore that. Analysis of profits and notes must be a part of your answer. Well, I think we can clearly see that apart from the upstream stock reserve, there's no adjustments. It's a very plain vanilla question in terms of chain holding, no adjustments given. Let's begin with the inputs. Is there any kind of omissions which are given in the question? No. So if there are no omissions as well, I think we are safe. We can directly start with a 7-step model. So answer to the question number 11. So whatever changes are required in the solution, we'll see as we proceed. So the answer to the question number 11, let's begin with the step number 1. Now there will be some new value additions in terms of step 1. When it is going to be a chain holding, there is going to be a little extra element to be taken care at this stage. Yeah, am I audible, friends? हाँ जी. Something I think happened. I don't know what. The laptop immediately just got switched over. Right. I hope, friends, I'm audible and visible to you. Seems to be a bad technical question, I guess. Okay, so let's begin the journey. So as I said, there will be a slight little, additional input in terms of step number one. Now, what will be that additional point? We'll see. Now, I am given the status in terms of the holding. Usha has got shares in Nisha, and Nisha has got shares in Sandhya. Usha has got 80% shares in Nisha, and Nisha has got 75% shares in Sandhya. So let's get the chain. So it says Usha has got shares in Nisha, and Nisha has got shares in Sandhya. And if I look at the percentages which are given, it's very clearly given. It is 80%, and this is supposed to be 75%. And the date is very clearly defined. It says all the shares are acquired on 30th September 17. So I just picked up the data from the question that all the shares acquired on 30th September, and there is a 80 and 75% holding. Now, the only new value addition which you need to do in terms of step number one is everything has to be seen from the point of view of the top company, which means that I will say, okay, Usha's got 80% shares in Nisha. We need to calculate what is the effective percentage. We need to calculate what is the effective percentage which Usha has in the lowest company, that is Sandhya. So the only thing which you need to do in terms of step one is calculate this effective percentage. Now, if Usha has got 80% in Nisha and then it is 75%, so can I say he's got 80% of 75%? So what is the effective percentage Usha has got in Sandhya? So in step one, when there is a chain holding, you need to see the effective percentage of the top company in the bottommost company. That's the only new addition.
60.
So that's right. It comes to 60%, which also means at this stage, you can identify that NCI in this particular case is going to be 40%. That's the only value addition which you need to do in terms of step one. Okay, now let's proceed further. So once you've taken care of the step number one, we go to the step number two. Undoubtedly, this is a question where the consolidation is taking place at a later date. So we need a step number 2A and step number 2B. Now, since it's a chain holding, it's as good as two subsidiary because the top company has got shares in the middle one as also effectively in the bottom company. So everything will be now twice. Two analysis, two net assets, two NCI, two goodwill. So everything becomes double. So basically, your workload enhances because now you need to do everything twice. So let's begin with the step number 2A, that is analysis of other equity. So I think I'll first organize the formatting. So when we look at the analysis of other equity, let's do two analysis. So we'll look at the analysis of both the subsidiaries. So let's take a pre and a post acquisition columns. So we'll define this also in terms of date. So this is as far as Nisha is concerned, and this is Sandhya is concerned. So this is pre-acquisition and this is post-acquisition. Define this in terms of date, what is pre and what is post. So this is pre-30th September. And this is anything I would say from 1st October till 31st March. This is pre-acquisition and post-acquisition. We'll define this in terms of dates. This is pre-30th September. And anything from 1st October till 31st March, that becomes post-acquisition. The focus points would remain the same. We'll look into the balance sheet of the companies. That means other equity of the subsidiary. There are no fair value adjustments which are given, but there is a stock reserve which is upstream. So we just need to take care of the balance sheet equity and the stock reserve which is upstream. So I'm just going to keep the question in front of me. You can also keep the question in front of you. So I am first looking at the Nisha status. Now, if you look at the balance sheet of Nisha, it has got reserves to the extent of 50 and RE to the extent of 25. So let's begin with reserve. Let's make a timeline. And in terms of the timeline, the reserves at the beginning of the year is 40. So this is on 1st April, it is 40. And the reserves at the end of the year in the balance sheet is appearing to the extent of 50. And mind you, the date of acquisition is middle of the year. So exactly the same way we do the analysis, we'll pick the figure 40 becomes pre. And what about this increase of 10? Is it post or divided in time ratio?
50-50.
Correct. Because this is 1st October, 30th September is as good as 1st October. So we need to divide this in the time ratio, 1:1. So we can say 5 becomes pre and 5 becomes post, and create a separate column in the post acquisition. Create a separate column in the post acquisition because we'll add reserve to the reserve and we'll add RE to the RE. In fact, whatever questions we have done so far, there has been no post acquisition reserve. So, but when you consider a post acquisition column, it is appropriate that we should segregate it, according to different items. A separate column for premium, a separate for reserve, a separate for RE, as the case may be. Because post-acquisition reserve will get added to reserve, post-acquisition RE will get added to RE, and so on. Okay, so this is done. Now let's go to the retained earnings. And again, we take a timeline. And let's consider the balance on 1st April and on 31st March. And I think if you look at the question data, the retained earnings on the beginning of the year is supposed to be 10. And in the balance sheet, it is appearing at 25. So I think the same funda would apply. The date of acquisition is 30th September. So we can say 10 becomes pre. And whatever is the increase, 15 divided in the time ratio. And the 7.5 is going to be taken under a separate column. There is no need to segregate the column in a pre-acquisition. Pre-acquisition can be taken everything combined, but in a post-acquisition, you must segregate the columns. Okay, and I guess that's it. The stock reserve point was, I think, pertaining to Sandhya made a sale to Nisha. So nothing to do with Nisha. I think we're done with the analysis of the equity. So let's take the pre and post. This is going to be 5. This is 7.5. And this is going to be 45 plus 17.5. This comes to 62.5. So there's nothing different in terms of how the analysis is done. Whether it's a chain holding or not, the technique of analysis will not change. The focus points, everything would remain the same. Now let's go to Sandhya. We do the same exercise. Take the reserves. Get the timeline, take the retained earnings, get the timeline. So let's consider the status of reserve on 1st April and 31st March, retained earnings on 1st April and 31st March. So if you look at the balance sheet of Sandhya, the reserves are appearing to the extent of 40. And in the addition, and we need the investments in both the company. Usha has in Nisha and Usha has in Sandhya. I did not say Nisha in Sandhya. I did not say Nisha in Sandhya. Technically, the investment is held by Nisha and Sandhya, but we need to convert this in terms of Usha and Sandhya. That's the new addition in terms of step 3. So let's look at the investment in the balance sheet. I think let's take you back on the balance sheet and say something. So if you look at the balance sheet of the company, we can see something very clear. Investment Usha has in Nisha is 170. Nisha has in Sandhya is 140. This is Nisha in Sandhya, but I don't need Nisha in Sandhya. I need the effective percentage which the top company Usha has in Sandhya. So can I say, since Usha has got 80% stake in Nisha, so can I say we should take 80% of this investment is indirectly made by Usha. So we can say that if you look at the investment, which is 140, 80% of this is funded by Usha. And can I say the remaining 20% is funded by outsiders? Would that be correct to say? Because this 140 is the money which Nisha has got. 80% shares of Nisha is with Usha and 20% shares is with the outsiders, that is NCI. So can you say 80% of this is funded by Usha and 20% is funded by the outsiders, that is NCI. Right? I guess agreed with the funda. So 170 and 140. So this comes to 170. And instead of this 140, we will take 80%. Let's see what is 80% in this.
112.
112. So I think it's worth making a mention at this particular stage that we can say 20%. 20% of 140, that is 28, is funded by NCI. You may not make a mention to this to the examiner. Yes.
NCI of USA or NCI of NISA, sir? Funded.
No, this is 20% of, you can say, shareholders of Usha.
No,
Because all the
20%.
share capital of Usha is funded, sorry, Nisha. All the share capital of Nisha, 80% funded by Usha, 20% funded by the others. So you can say it is the NCI of Usha, NCI of Nisha, the middle company, which has funded this money.
Okay.
Right. Now, why did I say that? You'll get to know when I come to the step number 4 and 5, then I'll give you the emphasis. So now let's go to the step number 4 and 5, which I would like to do jointly. Step number 4, and I like to do step number 5. So this is going to be presented jointly for a better understanding. Of course, once you get the understanding, you can do it separately in the exam. So this is NCI, and this is the goodwill calculation. I'm intentionally presenting them together to make things clear. So we need 2 NCIs and we need 2 goodwills as well. So let's first organize the input. We'll first organize the data. So in terms of NCI, we've got Nisha as well as Sandhya, and goodwill also Nisha as well as Sandhya. These are the 2 subsidiary companies for which goodwill will be seen, and everything will be seen from the point of view of Usha, the top company. So remember, the NCI here was 40%. And the percentage stake which he has got is 60%. So we're just keeping the focus point. Let's forget about the figures. Let's first organize the data. Then we proceed further. So NCI will be taken on date of acquisition. To this, we will add the share in post-acquisition. There is no goodwill impairments, nothing. And here we take the purchase consideration, to which we add the NCI on date of acquisition. And we compare this with the net assets on date of acquisition. And we will be able to get the amount of goodwill or the amount of bargain purchase gain, that is capital reserve, as the case may be. Okay, now watch this carefully as we do the calculations. Now watch this very, very carefully. Let's, I think, first of all, focus on the calculations of the goodwill. Before the calculations, or maybe NCI, let's calculate the NCI. Now, as far as the NCI is concerned, we are given in the additional information. It says in point 5, the parent company adopted the policy to measure the NCI at a fair value, applying 103. Assume market price of Nisha and Sandhya are same as the face value. He says, assume that the face value of the equity shares and the market value of equity shares is same. So let's take the data. So we know the share capital of the company is 200 and 160. So let's take this. So this is 200 and 160. So NCI on the date of acquisition, this is 200. And I think the NCI here was 20%, I guess. Is that correct?
Yes, sir.
Right. So we take 20% of the share capital, which is considered as a market value. And here it is 160, but we take 40% of this, that is 64. So we've taken 20% of the share capital and 40% of the share capital in this case. Then the share in the post-acquisition profits. We go to the analysis. I guess the post-acquisition is 5 and 7.5, 12.5, 5 and 6.5, 11.5. So this was, I think, 12.5 into 20%, 11.5 into 40%. So this is on the NCI. So this is 12.5 into 20%, 2.5. And this is 4.6. I'm not taking the total right now. We'll come to some more calculations very soon. Let's come out here. Purchase consideration is 170 and 112. This is 112. Now, watch this carefully. We are not taking 140, but we're taking 112. So what about this 28? You want me to give you the logic of what I'm doing, or you want me only to tell you this is to be done? Your silence tells me I will just tell you what is to be done at the moment.
No, logic also, sir. Logic.
Okay, so first let me tell you what is to be done, then I'll come to the logic. So this is 80%. The remaining 20%, if you remember, I said is funded by Nisha's NCI. So what I'm going to do, I will reduce that 28 from here. Why? Don't get worried. I'll explain that very shortly. Why? I'll explain that. But 20% funded by the NCI gets reduced here. I'll explain the logic in detail. Let's first finish the calculations. NCI on the date of acquisition is 40 and 64. And net assets on the date of acquisition, 262.5. This is 262.5 and 217.5. So let's calculate what is the goodwill or the capital reserve. 52.5 is the capital reserve. $41.5 is the capital reserve. Let me just add the two as well. the total capital reserve comes to 94. Let me do the calculations, then I'll explain this in detail. So this is going to be 68.6 and this is going to be 14.5. Let me just add this up as well. That comes to 83.1. Okay, so the only new thing what we have done in this case is we made the reduction of the 20% funding from NCI. Now, why did we do that? Let me explain that in a good detail to you. So watch this carefully because the next 5 minutes, you're going to get the logic of why this 28 is getting reduced from this figure. Let's see. Let's, I think, first of all, visualize something. I'm looking at the balance sheet of the parent company, that is Usha. There is an investment which is appearing in Nisha, and I'm also looking at the balance sheet of Nisha, where there is an investment appearing in Sandhya. And that is appearing to the extent of, I think this was 170. And I think this was how much?
140.
140. So this was appearing at 140. So these two investments are standing in two different balance sheets. Now, watch this carefully. This represents 80% and this represents 75%. Now, let's make the consolidated balance sheet. Let's make the consolidated balance sheet. I am only concentrating on investment Nisha has in Sandhya. I'm just looking at that. When you aggregated the assets and liability, they were aggregated 100%. When you calculated the goodwill, that goodwill was calculated based on 60%. When you calculate the NCI, it was based on 40%. Agreed till the stage? I'm talking of the company Sandhya. So asset liability of Sandhya aggregated 100. The goodwill is based on a 60% Usha in Sandhya. The NCI is based on 40% Usha in Sandhya. Got to the stage right?
Yes, sir.
Great. Now, let's have a look further. Now, in this particular case, out of this 140, what went into the goodwill calculation was 80%, that is 112, correct? When I did my goodwill calculations, I took only 80% of this investment, 112. So will this investment not appear to the extent of 112 or will it not appear to the extent of 140? Remember my 4 golden cases which I did earlier. In the calculation of the goodwill, only 80% investment went. So will the remaining 20% investment continue to appear in the balance sheet or not?
No, sir.
Just think about it again. When you did the goodwill calculation, did this entire 140 enter the goodwill or only 80% entered the goodwill?
80%.
So once we decided our 4 cases, we said investment does not appear. Why? Investment gets eliminated and because it enters the goodwill calculation. But in this case, did the entire investment enter the goodwill calculation? No, it did not.
No,
Should the remaining 20% investment appear in the balance sheet or not?
Not.
no, sir. It should.
Now think of it on a mathematical level. You see, had you taken this entire 140 in the goodwill calculation, let's do one thing. Let's also show you, this is the consolidation from the point of view of Sandhya. Let me also show something from middle company Nisha point of view. Let's also see the Nisha's perspective and then compare it with the Sandhya's perspective. So in the Nisha case also, did I aggregate all the assets and liabilities? Yes. I took the goodwill based on what percentage? 80. And I took the NCI based on what? 20%, correct?
Yes, sir.
Now tell me one thing. I'm looking at now the middle company, that is Nisha. So the investment of 170, did it entirely go in the goodwill calculation?
Yes.
This entirely went in the goodwill. So will it appear in the balance sheet? No. Remember when I was telling you the 4 cases of consolidation, I said investment gone. Therefore, it does not appear in the balance sheet console because it is gone in the goodwill calculation. So this entire 170, mind the words, this entire 170 went in the goodwill calculation. Now let's come back. Did this entire 140 enter the goodwill calculation or only 80% entered?
Only 80%.
80%.
So now the question is on a mathematical front, if only 80% of this investment went in the goodwill calculation, can you say that this investment will not appear in the balance sheet or the remaining 20% will appear in the balance sheet? Now, did you get the logic? No. Say no if you didn't get it. Okay, let me put it like the other way around. Why does the investment not appear in the consolidated balance sheet? Give me a reason now. When there is a investment in the subsidiary parent company's balance sheet, why does it not appear in the console? Give me a reason. That's right. So I think who was answering on the mic, are you convinced? The goodwill takes care of that investment calculation and therefore that investment cannot appear in the balance sheet. But remember, when you did the goodwill calculations in this case, you took 112 from the point of view of the top company. You never took the entire investment. You took only 80% investment in the goodwill calculation. So what about the remaining 20%? Can I say the remaining 20% should appear in the balance sheet as an investment? Agreed on a mathematical front?
Yes, sir.
Yes. Now, the problem is that if in my consolidated balance sheet, I show this 28 investment, people will say, what is happening? Why are you showing this investment of 28 in the console? So now the question arises, is this the money which the NCI funded? Is this the investment held by the NCI? Yes. So why not set it off? Are you getting my point? Why not set it off against the NCI? This money is, on one side of the balance sheet, you will say payable to NCI. On the other side, you will say this is what the NCI needs to recover. So it is better to set it off because NCI appears on the balance sheet on the liability and the investment funded by the NCI on the asset side. So we're doing a netting off in this case. Therefore, when I did this calculation, since this 28 is the money which the NCI of the Nisha company has funded, this is the money which is funded by the NCI of Nisha. And that's the reason I made a mention out here that 20% of this is funded by NCI of Nisha. Since it is funded by NCI of Nisha, so this 28 should actually appear on the asset side, but that will not be logical. So on the liability side, you've got NCI of Nisha. On the asset side, you've got investment, which is made by the NCI of Nisha, set it off. And therefore, when we did this calculations, we have reduced this 28. This is basically, you can say, to set off the amount. Did you get the picture clear?
Yes, sir.
Great.
Yes, sir. Got it.
Wonderful indeed. So now with this, we know what is the crucial points to be done in step 4 and 5. So basically in step number 3, you need to consider the investment from the point of view of the top company. In step number 4 in NCI, you need to set off that remaining investment. And when you consider step number 5, you need to consider the value of investment from the top company's perspective. Okay. Now let's go further. Step number 6. So let's go to the next one. That is step number 6. Now here again, in terms of step number 6, we will not segregate, the two calculations of other equity, because now there are two subsidiaries, so everything will become twice. So when you consider the consolidated balance sheet other equity, so here again, let's take a columnar information. So we'll take the inputs in terms of two column. I guess there is a reserve, there is a retained earning. We'll take holding company's own other equity. Now the focus points would remain the same, except that now when you consider the information, the share in post acquisition will be Usha in Nisha, Usha in Sandhya. So everything will become double. So what we'll do, we will add the share of holding in subsidiary post acquisition. So we'll have to take care of two inputs separately. Usha is got in Nisha and Usha is got in Sandhya. This is based on 80% and this is based on 60%. Everything from the point of view of the top company. I think there is no goodwill. There is a stock reserve, but that's not taken here. That was upstream in nature. Let's go back to the balance sheet of the parent. So first of all, in the balance sheet, we have got the reserves is appearing at 90 and the retained earnings 80. Reserves is 90. Reserves is appearing at 90. Retained earning is appearing at 80. Now let's consider the post-acquisition share, step number 2A. In terms of step number 2A, we get the post-acquisition share.
12.5.
No, we'll take it separately. So we'll take 20% of this, 20% of this separately. We'll take 40% of this and 40% of this separately. Reserve in reserve, RE in RE. So let's consider the reserves was, I think, 5 into 80%. This was, I think, again
7.5.
okay.
Right.
Reserve was 7.5.
No, sir. No, sir. 5.5.
Reserve was 5.5.
Yes.
No?
Yes.
This is into 80% and this is, I think, 60%.
60.
And this was, I think, 7.5,
7.5.
6.5
Yes.
into 80% and into 60%. So this is going to be 4, 3, and this is going to be 3.9, 6. I think that's it. No other adjustments are given. I think we are sorted. So let's get the sum total of this. And I think there was a capital reserve, right?
Yes, sir. 94.
So we'll take that also into account. There is a capital reserve as well. So capital reserve was 94. So that will also become a part of the other equity in the balance sheet. So this is 89.9. This is 97. Let's add all this up. I think it's 280.9. Right, so step number 6 is taken care. Now we go to the step number 7. So that's making a consolidated balance sheet now. So we go to the step number 7. That is making a consolidated balance sheet. Now there are effectively 2 subsidiaries, so we'll need a total of holding company column, 2 subsidiary company column, adjustments, and the total. So all the subsidiaries will be consolidated now in this case. So let's, I think, organize the information. The parent company, the two subsidiaries, adjustments, and the total. So this is, I guess, Usha, Nisha, then Sandhya, then there is adjustments, and then there is total. So let me, I think, begin with the asset side of the balance sheet. So we've got the non-current assets, keeping the balance sheet with me. So we've got the tangible assets, that is PPE. That's, I think, 160. Then it is 180. It is 160. Then it is supposed to be 180 and 150. And there is, I think, no fair value
490.
adjustments.
Total 490.
That's total is 490. Correct. Then investments will not appear in the balance sheet, but there is no goodwill either. Then we given the current assets. And that's cash 114, 20, and this is again 20. So no adjustments, 154. Then next we given the bill receivable. I think there is some intercompany owings within the balance sheet. Because if you look at the bills payable on the liability side, it's payable to Usha and Sandhya. So 35 plus 15, 50 will be eliminated. So bill receivable is 36, 0 and 15. Then there is an intercompany elimination of 50. So 36 plus 15, I think it's coming to net 1. Then there is a trade receivable. Trade receivable is, I think, appearing at 130, 50, 110. And I don't think so there are any intercompany owings in this connection. So 130 plus 50 plus 110, 290. Then there is inventory. There was a stock reserve to be taken. So inventories is 110. Then it is 35, 25. And stock reserve, I think, was 1, right?
160.
169. I think that's it on the asset side. So this should give me the total of the asset side of the balance sheet.
1104.
1104. Okay, so this is on the asset side. Same lines, we will prepare the liability side as well. Let's go to the equity liability. So let's consider the parent, the two subsidiaries, adjustments, and the total as well. So same formatting. So this is the holding company, that is Usha. This is Nisha. This is Sandhya. And this is adjustments, and this is total. So we consider the equity and the liability side. So let's first consider the equity side, equity share capital. So on the equity share capital, just the parent, that's 300. Other equity from the step number 6, 280.9. And there was an NCI that was 94, I guess.
83.1.
Sorry,
83.1.
83.1. Okay. And then there are no non-current liabilities. So we've got current liabilities now. Current liabilities, we've got trades payable. Bills payable will get eliminated. So trades payable is appearing at 235, 115, and 90. And there's no intercompany owings in this case.
440.
440. Then there is bills payable, though it'll get eliminated, but we'll still show it. So bills payable is appearing at 15 and 35. And the elimination of 50. So this is 0. I guess this should tally the balance sheet. 1104, I think, is the total.
Yes, sir.
Right. So the balance sheet is agreed. Wow. So that gives me the consolidated balance sheet in terms of chain holding. Wonderful indeed. Okay. Now, I'd just like to make a quick summary chart of the inputs in terms of chain holding, the crucial points which you need to take care. So that you know the things are very clear in the mind that what are the crucial points we need to take care. So let me just make a quick summary point at this stage. So I'm just making a summary view in terms of chain holding, that what are the crucial points to be taken care in terms of all the step-by-step approach.
Sir, how many times required for chain holding
Frequency in the
in the
exams?
exam? Yes, sir. Half an hour.
Not much, not much.
Don't think so. It is asked since
Plus
last
14,
5, 6 years.
14 marks.
How many marks? It would be around 15, 16 marks only. But I think it's come around twice or thrice, if I'm rightly remember. Twice, definitely for sure. But the frequency is not very great. But then I think if you just look at the overall 2018 to 2025, it's been almost 7 years. And in 7 years, if you see the frequency, yes, it's pretty less. Okay, so let's, I think, quickly pen down the inputs in terms of the crucial things in step one. Anything crucial in terms of step one? Yes, we need to compute. We need to compute the effective percentage the top company has in the bottom company. That's the crucial point. That's the only addition in terms of step number one. Anything special in terms of step number 2A and 2B, or they continue exactly the same way? It's absolutely usual. There's nothing specific which is done in terms of 2A and 2B. Then in terms of step 3, can I say we need to consider the purchase consideration from top company's point of view? We need to consider the purchase consideration from the top company's point of view. So that is another crucial point. Then in terms of the step number 4, that is NCI. Can I say from middle companies NCI? From middle companies NCI, we reduce the amount funded by, the amount of investment funded by NCI. The amount which is funded by NCI. So that is the crucial point you need to take care in terms of 4. Then number 5. In terms of the goodwill, can I say when you calculate the goodwill of the bottom company, when you calculate the goodwill of the bottom company, we need to consider the investment. We need to consider the investment from top company's point of view, which you have already organized in terms of the purchase consideration. So I'm just penning down all the important thoughts at one go, that what are the crucial points you need to take care at each and every step. And then finally, in terms of step number 6, we need to consider calculations. We need to consider calculations as if there are 2 subsidiaries. As if there are 2 subsidiaries. So we'll take both the post-acquisition shares from both the companies' point of view. And then finally, in terms of step number 7, we need to make a consolidated balance sheet and we'll aggregate assets and liabilities of both. We'll aggregate the assets and liabilities of both subsidiary companies. I think that's the crucial elements which we need to take care. Right, friends, so far so good. I think that summarizes the key aspects in terms of chain holding. Trust me, when you do it for the first time, it looks a little more complicated, but once you are going to do this by hand, you're going to get more confidence in this case. Trust me. Right, friends, so balance sheet perspective is done. I think more or less we have covered all the adjustments. So now my perception is going to change on the concept of doing a consolidated income statement. Don't worry, I'm not going to start it right away. So balance sheet is done, but we are not done with Ind AS 110. There are two more aspects in terms of Ind AS 110, which I'm going to wind up in the next session. One is we're going to focus on the consolidated income statement. So consolidated income statement will also have certain key issues, just like a balance sheet. So what my thought is coming is that, if you need to get a lot of clarity in terms of these adjustments, I'm just giving you a chain of thought. We'll perhaps work on this after Ind AS 28. I've given you a total of, I would say, 5 adjustments. I'm leaving the dividend because that dividend is more, to do with a consolidated balance sheet. So typically there are 5 adjustments. Now, at the end of the consolidation, you need to be very clear that what is the treatment of these 5 adjustments in the consolidated balance sheet as per 110, in the consolidated P&L as per 110. So all the 5 adjustments need to be clear. How do you tackle them in the balance sheet? How do you tackle them in the income statement? 1. Then once we go to Ind AS 28, we need to be clear that even in terms of associate company, how do you tackle these 5 adjustments in a consolidated balance sheet? How do you tackle those 5 adjustments in a consolidated P&L? If you're able to make a wonderful chart, I know now where your thoughts are going. If you're able to make a wonderful chart consolidating that these 5 adjustments are taken care in the consolidated balance sheet, in the consolidated income statement, as per 110, as per 28, life jingalala. I'm sure you'll be wanting me to make that consolidated chart after the end of Ind AS 28. Say no, I'll not do it. There comes a yes on that. Okay, so I think if the time would permit, I would give you a consolidated sheet after 28 that once all these 5 adjustments are seen, we're going to make a comparative chart from 110, 28, balance sheet, P&L in all the perspectives. You will get a complete clarity. So even if a question comes on a balance sheet, which is a subsidiary asset combined, we will stand very comfortable indeed. Right, friends. So I think that's all. I'm not taking this further. In the next session, we're going to concentrate on consolidated income statement and the third block, which is changes in ownership interest. So that's all, unless you've got any questions. Otherwise, I think that's all for the day. Right, friends. So time to say goodbye to you. So please revise this and see you in the next class. Thank you. Bye-bye and take care.
Thank you, sir.
Thank you very much. Haji, thank you.